Hello, chart watchers, and welcome to this Tuesday, July 2nd, 2019 Market Watchers live show with your host, Tom Bowley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Taking a look at today's market action, you can see the Dow Jones Industrial Average currently down about 13 points. The S&P 500 down 1 and change. The NASDAQ down 16. The Russell 2000 down 13. So underperformance in a pretty significant way there on the small cap index. 10-year Treasury yield continues moving lower, back down below 1.99%, threatening the lows that we saw in the middle part of June. Volatility index continues to drift lower, even though the market is down slightly on the day. So volatility continues to drift lower. That is bullish for the market. Mobile telecom having a very strong day. A number of these industry groups, I just pointed out some of the areas that are leading and lagging today. You can see mobile telecom doing very well. Still got some work to do to get through that 385 level. Toys, we've been talking about toys quite a bit on here, waiting for this breakout above 840. Since we've gotten it, toys have been leading the market to the upside. Very important to note that change in character on the toys chart. The telecom group also bouncing here off of its moving averages after a pretty rough last week and a half. Specialty finance making a breakout above 290, very important there. Also, I think important, defense after putting in equal highs and an intermediate low there. You can see we're putting in another low on the 20-day moving average. This could be an ascending triangle forming, equal highs, higher lows. A breakout above that 470 level would be very bullish. Automobiles not doing well today. This is a group that's been very strong over the past 4 to 5 weeks. Unfortunately, the long-term track record for autos is in question. And so when I see that reversing candle yesterday, backing off here, I'm going to want to watch this 175 level to the downside. That's where we've got our short-term 20-day moving average, also recent lows around 175. That needs to hold, I think, or I would be careful given that long-term track record in the group. Semiconductors, after a huge run recently and the big gap up yesterday, one of the worst areas today, but I think we're seeing some profit taking there. In the energy space, exploration and production stocks, nasty candle yesterday, shooting star candle, right at resistance. And now today we're right back down 2.5%. One of the energy stocks, and the energy stocks are littered among the underperformers on the S&P 500. Apache, after testing gap resistance and this 30 level, not to mention the 50-day moving average, did reverse yesterday and is breaking back down. This, to me, looks like a wedge, a bearish wedge. You can see the highs going up, nice trend line. This, or the lows, I should say, the highs, if you connect those, it's like a wedge forming off almost like a piece of pie off of a downtrend. This breakdown, I think, now brings this prior low under 26 into sight for Apache. Okay, Erin, overall, I think the market's doing pretty well, but as I just went through that update, you can see a lot of areas of the market on different sides of the spectrum. Some doing very well, others not so well. So it's going to be a stock pickers type of situation here.
Yep, I think you are right. We're just not seeing consistency right now. It just keeps bouncing from one sector to another. It's hard to get a bead on what's actually going on here as far as that rotation goes and, which ones are going to lead. But I'm with you. I mean, good thing we're doing chart breakouts today because it is a stock picker's paradise, right?
Yeah, and I understand definitely what you're saying in the short term. I think from a longer term perspective, if we step back, I think the money has rotated fine. I think the market's still in pretty good shape. But short term, as we've seen such choppiness with the big drop in the fourth quarter last year and then the big rally, then another big drop in May, April-May period, and now the big rally, S&P back at all-time highs. There's just been this massive back and forth between the bears and the bulls. But I still think the big picture says the bulls are winning. I'll talk about that a little bit later in the show. But why don't we get rolling? What do we got for today?
Absolutely. Well, we've got a pretty exciting upcoming schedule. Tomorrow, the Chartwise Women premiere. Mary Ellen and I are doing a brand new show. We can't wait to show it to you. So tune in tomorrow at 4:30 Pacific time to watch that. Of course, Thursday, no Market Watchers with the 4th. Wednesday of next week, we have Tony Dwyer coming in. John Murphy will be here on Thursday of next week. And then looking Further ahead, Martin Pring is going to join the show on Wednesday, the 17th. And we're hyping a little bit our Relative Strength Week coming up July 22nd through the 26th. Today, I will be doing, after technical news and headlines, an introduction to momentum indicators as a workshop. Lots to show you there. Verizon is going to be our first 10 and 10 symbol, VZ. We have a market forecast Tom's going to give you for the rest of the year. And then, as I mentioned earlier, we're going to do chart breakouts to finish out the show. So let's go ahead and get it started. Technical news and headlines.
Yeah, there really wasn't anything in terms of economic news out today. And here you can see the 10-year Treasury yield down 5 basis points right now, 1.98%, testing the recent lows. That PPO is starting to rise here. So it's kind of a mixed bag. I think that this holds a lot of clues to the market going forward. Obviously, if the 10-year Treasury yield continues moving down like it has in 2019, that doesn't necessarily mean the S&P 500 can't go higher, but it is taking money away from the S&P 500. In order for the yield to continue dropping, money goes into treasuries. And so every dollar into treasuries is a dollar that can't go into equities. When this reverses and we see a move back to the upside, like we saw back in 2016, and then to the highs throughout 2018, when you're seeing 10-year Treasury yield rise, money is rotating away from treasuries, and that tends to find its way into the equity market. So we could still go higher in equities with this 10-year Treasury yield drifting lower, but I think the real big move to the upside would come if the 10-year Treasury yield were to rise. So far, no signs of that. As far as earnings go, there were a couple reports out. A couple of decent, well, one particularly good report was the Simply Good Foods Company. Apparently, it's a Simply Good stock as well, because not only they beat on the top and bottom line, but I will show you in 1 second the reaction to that report. AYI, Acuity Brands, did beat on the top line, but the reaction there was not nearly as strong. And when we look at the numbers, they missed on their top line, AYI. So as we take a look at the relative chart on AYI, you will see that we had the big gap down. Now, I'm going to go through a number of charts here, and I hope that by now everyone's getting a better sense of relative strength, but I'm going to go through a series of charts here that I think almost tells you the news that's coming before we actually get it. So Acuity Brands reports its earnings results today. You can see the heavy volume, the move lower, it's down 7% today. This stock was trading near a 52-week low relative to its group. Look at the group. The group has been incredibly strong versus the S&P 500, and yet AYI has simply gone along for the ride with the S&P 500. It has been a horrible performer within the group, and they come out, and now today they report that their revenues came up 22 million short of expectations. I think that was the market telegraphing what was going on. SMPL, the Simply Good Foods Company. Well, it's also a Simply Great investment. Here you can see food products been going up, pretty steadily, near a 52-week high. Relative to the S&P, though, it's just so-so. But Simply Good Foods Company has actually broken out here to a relative high versus the food products group, and it was already trending higher. It was already it's been telling us that this is one of the better stocks within the group. Today, they announced their revenues, $139.5 million. The market was only expecting $120.9. The earnings per share, as I showed you on that slide, 16 cents versus 14 cents. And you can see the stock moving up on very strong volume. So once again, it's almost as if the charts are telegraphing the news to come. Greenbrier, GBX. Look at the chart. Would you expect great news coming out of this company? Look at the relative weakness on this versus the peer group. The peer group has actually been rising relative to the S&P 500 for about 6 weeks, and yet the stock keeps moving lower versus its peers and the S&P 500. So what happened? They came out with earnings. They guided. Well, first of all, they missed their revenue, $856.2 million versus $863.2 million, so $7 million short. They missed on their bottom line, 89 cents versus 96. Then they guided their Q4 revenues and earnings per share lower. Now, maybe that's the final, throw in the kitchen sink kind of announcement, but the chart's been pointing us to this moment throughout. It remains in this downtrend, not only on an absolute basis, but obviously on a relative basis. And now we're getting some news to basically tell us why everyone's been selling the stock for the past several months. A couple of pre-announcements this morning. Let's take a look at these. So Ceragon Networks, CRNT, guided Q2 revenues lower. Well, anybody following the relative charts knew something was coming. The telecom group has been doing pretty well on an absolute basis, but look at Ceragon. It has been underperforming for 4 months. It's at a 52-week low, and today the announcement comes. Next up, AMRN. They guided their Q2 and fiscal year 19 revenues higher. Well, on a relative basis, this has been a stock that's been one of the better performers within the pharma space. CYBE. This is cyber optics. Look at this chart. Been downtrending since February. On a relative basis, near its 52-week low versus its peers. Not a lot of volume, so this isn't a stock that I would consider trading. Just again, trying to explain how relative strength can help you. Here, it is a stock that has been just kind of tossed to the side. Today, they come out, they guide their Q2 revenues lower. How about Perrigo, PRGO? This is another pharma. Now, this stock actually came out, they guided their earnings per share higher for the fiscal year 19. And you say, well, this one has actually been in a downtrend. I'm surprised they got the good news. But even after being in a downtrend, coming out with good news, look at the response. It's up 1.6%. It is starting to show some life. Maybe that'll continue. The relative strength has just begun here versus its peers, but this one's got a lot of work to do. And then finally, how about Delta coming out and guiding their Q2 earnings per share higher? Look at a relative leader in the airlines. Delta has been one of the strongest stocks in the space. Today, they raised their guidance. Still have some work to do to get through this overhead area of resistance, but it is a stock that has been performing extremely well. All right, looking at the scooter movers, and for those of you who are not familiar with the scooters, it's the StockCharts technical rank. It is an exclusive feature here at StockCharts and can point you to some really good trades or some really bad trades. It was one of the leaders, I believe, the one I'm going to show you here was one of the leaders in the small cap universe. But let's take a look here, and let me update this. It is sitting at 60.1. It is still rising. It's been rising. This is the scooter rank. It's been rising here over the past week or so. But, and this is a big but, I think this is an area that we want to be real careful with the stock. It is in the biotech space. It has been downtrending for the most part relative to the biotechs. If you go back and you check the recent highs over the last year and draw a trend line, you can see that we have moved a little bit above it. The volume picked up, but we have had multiple highs, and this has been a key pivot area for this stock over the course of the last year. You can see October, a couple big lows there, another big low in March, testing again throughout March. April, we break down. Look at all the recent highs up around 49.5 to 50.5, and here we are again. So yes, the scooter is telling us to look at this stock, but I think the chart is telling us that this stock has a lot more work to do. That is your scooter mover of the day.
All right, time for some upgrades and downgrades. I have 3 upgrades for you today and 3 downgrades. We are going to start with Cars.com. They were upgraded today by Citigroup from a neutral to a buy, and the target was raised to $24. So I've got my horizontal line ready here. Let's get ourselves up to about $24. There's 24.5. There we go, right there. And look at what it happens to line up with. This low back here in October. It also lines up with this gap support that we ended up losing. And, you know, now it's also matched up pretty much with that March top as well. So that's what they're looking for, is overhead resistance on this upgrade. You know, let me get this trend line tool. Personally, I can't get too excited about a stock that's been in this kind of a downtrend for so long, and we haven't even seen it break above this declining tops trend line. So we're not even in an uptrend, so to speak. We did get a nice gap here to the upside. but it's already kind of looking like we could end up with a shooting star today, which is a negative candlestick pattern. So, I could see the upgrade, but and then you could make a case here for a declining wedge if we draw those together here. And a declining wedge is a bullish pattern. You're supposed to expect a breakout to the upside. So, I could see the potential for this breakout, but again, I generally stay away from stocks that are trending downward like this. Even in the shorter term, it's just you're setting yourself up for, you need to be planting your seeds in fertile ground. And when you're looking at a stock that's been in decline since January, basically, that's personally not where I would want to put my money, despite this upgrade. Frank's International, FI, was upgraded today by Tudor Pickering from a hold to a buy. And you can see that it's been in a trading range here. Let's get that here. There we are. So we've got a trading range right about here. So we've been within this range really since most of the year. We've been up and down through it. We did see a breakdown, didn't have to come down and test that support level though. So I guess that would be a positive, but you could make a case for a reverse flag here. A lot of nice volume coming in here to the upside though on this rally. So that is encouraging. And we are getting that move back up into that trading range. So we did not get a target from Tudor Pickering, but I think this one could be interesting. But again, now I would look at this in the shorter term and playing the trading range, getting in low, getting out at the top of the range. That's usually a pretty good play in the short term. PMO is starting to decelerate, and that's looking pretty good. And yes, there's that volume on the OBV that is supporting this move to the upside. So we could end up seeing it back in that trading range, moving back and forth. MPW, Medical Properties Trust. This was upgraded by SunTrust today from a hold to a buy. They moved from a $19 target up here, and they moved it up to $20 right about here. So they are looking for some good things to come out of medical properties. Okay, we do still have our horizontal line. Overhead resistance would be right about here at 1867, as you can see. And then, as far as the support level, I think you can make a case here for a rising and ascending triangle. And let me show you that right here. So you have rising bottoms on the bottom, and then you should have overhead resistance or tops that end right about at the same time. And that's what we have here. So the expectation would be an upside breakout out of this pattern. But of course, we still have time to wind ourselves through the pattern before we actually can get the breakout. So we don't really know. But the PMO is turning up just as it had just gotten below zero. So I think that is a positive. You could probably look for it to move up to that 1860 level to challenge those highs that we saw previously. But with a big move like this to the upside, might want to wait it out just a little for a slight pullback. 3.35% move to the upside today. KOTY moving to the downgrades. KOTY was downgraded today from a neutral to a sell. The price target was moved from $14. See, do I have my, need my horizontal line here. The price was moved from $14 target down to $10. So they're certainly not expecting much to come out of KOTY. And you can see there, the PMO went into a sell signal a while back here in June before we even got this horrible day yesterday to the downside. And we're continuing now below yesterday's close, currently down 0.35%. The next one I want to look at is JW Nordstrom. And, the apparel retail, this area of the market has just been beat down. And it does look like we are hitting some support here, right at that level there, about $30.80. But you can see that the PMO is already starting to turn over. You know, if I'm looking for a bounce off of support, I certainly don't want to see, number one, a negative PMO and one that is trying to decelerate and turn over. Notice also that the OBV got those declining tops, which is confirming the declining tops on price. It hit that 20-day EMA and was unable to get above it. I don't see anything good coming out of JWN. They've moved it into the neutral position. I guess you could look at it that way and just look for movements sideways, but certainly not anywhere to put your money. And finally, Roku was actually downgraded today. I know we always have a lot of interest in Roku. And RBC Capital downgraded from an outperform to a sector perform. So they're moving it into neutral. We're not moving to a sell like we saw on KOTY. So where are our price barriers here? There's our support, but you could also go all the way down here to this gap. You can see right in here, right between these two. So that could also provide support even if we don't hold this area right here at about $74.69. So the price target, though, that they have for it is $90, which is right about here. And we're already breaking down below that. So I would look for a move further down. I mean, a lot of times, though, this is kind of a fake out, you know, to shake out some of the bulls. And it might move down lower, but then we get that turn to the upside. It is sitting on that 50-day EMA. I'm not looking for anything good right now out of Roku based on this chart. It is moving to the sector perform. So, but sitting here at a target of $90 and it's already starting to trade below that. Not too excited. All right, that is your upgrades and downgrades. Here are the ones that I went over and the long list that I did not go over on downgrades. Huge list today. I do have the link for upgrades and downgrades in the MarketWatchers live recap. At the bottom, you'll find the link to get your economic reports, your earnings, and your upgrades and downgrades. So if you're curious, that's a place you can go. All right, I'll be right back after this with my workshop on momentum indicators, so stick around. We are back here at MarketWatchers Live. I am going to be doing a workshop today on momentum indicators. I'm going to give you kind of an introduction. I've got some great charts to show you with some examples. Excuse me. So let's go ahead and dive right in, and I'll explain to you some of the things I'll be covering. So of course, we're going to look at the definition of momentum, and we're going to cover the common momentum indicators, the rate of change, the RSI, stochastics, MACD, and PPO, and of course, my favorite, the price momentum oscillator. So we will look at all of those and some examples. And I also set up a chart with all of them on it, just so you can get a feel for, you know, how these are similar and how they're very different. And let's go ahead and start with our definition. So momentum really is as simple as this. It just analyzes the changes in price instead of levels. It's just right up there, what's the change from yesterday to today? What's the change between last week and this week? And that's technically what the definition of momentum really is. And so momentum gives you the speed, the movement, and the rate of ascent or descent. So you're looking at kind of a picture of what happens on your accelerator. You know, when you start pushing down on the accelerator, of course, your speed starts to move, starts to go up, your movement is moving up, and then your slope, or, you know, what you're doing with your accelerator, you're pushing further down, and that's your rate of ascent or descent as far as the momentum goes. So hopefully that makes some sense. It's also synonymous with slope, because again, we're looking at the rate of the ascent and the descent of, you know, your acceleration. So if you remember from your algebra calculus days, it is the slope when we talk about you know, a Cartesian plane on a piece of graph paper. It is also known as rate of change. So we talked about the change in price versus change in price levels, but momentum truly is just the rate of change. And that, of course, will be the first one that I'm going to go over. One thing to understand is momentum indicators typically are leading indicators versus lagging moving averages. So when you look at the moving averages on your price chart and the crossovers, or, you know, where the price is in conjunction with the moving averages, they tend to move slower. You know, they have to take in account a lot of data, more than likely. And so they just tend to move slower, and looking for crossovers and that sort of thing, you a lot of times are going to get in late if you're just going strictly by moving averages. This is why with the decision point analysis process, I always include not just price and moving averages and their crossovers for our trend models, but we also follow the momentum of the price momentum oscillator. And adding all of those in, moving averages and momentum, it does give you a pretty good picture of what's going on with the stock. And of course, you add the OBV, or volume, to your charts, and you have even more information. So let's go ahead and we'll start with the simple momentum formula. So it is very simple, because what we're saying is we're looking at the difference between two prices taken over a fixed interval, or N days, however many days you want N to be. So momentum, price minus the price at that time, N days ago. So if N is, you know, 7, if that's, you know, or 5, that means 5 days ago or last week on Monday. You look at that price and subtract it from the current price. And that tells you what momentum is. And here is another example with 5 days, price minus the price 5 days ago. And that's the simple momentum formula. Rate of change, you can actually put this on your charts as an indicator here at StockCharts. And it's basically the same sort of thing, only we look at it as a percentage change, rate of change. So the momentum, of course, is your close minus the close on that day. But now we take it and divide by that close and then multiply by 100. So basically, you're just taking the percentage of the rate of change over that many days. So for example, N, let's just stick to 5 days. It's pretty easy to visualize. So let's say the close today was $25. The close 5 days ago was $22. So momentum would give you a positive $3, right? So let's find the 5-day rate of change. So 25 minus 22, that's going to be your 3, and then divide it by the close, N days ago, or in this case, 5 days ago. So we'll divide by 22, and we multiply by 100. And so our rate of change, 5 days, a 5-day rate of change, was 13.6%. So, I mean, we figure this out just to see the percentage gain that we make. You know, that's pretty much what the rate of change is. So if you want to have that on there and know what your gains are over a certain period of time, you can look at least the percentage change over time. So here is the chart with the rate of change, and I put in the one that is the default is 12 days. And then I just added, just so you could look at it, the rate of change for 50 days and the rate of change for 200 days. So they have a similar look to them, do they not? Not exact, but they are, it just gives you a way to see what is happening with, how much of a change is this from 12 days ago. That's what you're looking at here. Changes passing through the zero line, I think, is usually something we look at as far as a signal goes. I mean, those are still hit and miss. I prefer my oscillators. I'm sure most people prefer the MACD or the PMO or the PPO. But this is just giving you a graphical version of what the rate of change looks like. The next one I'm going to look at is relative strength index. And there's a lot of confusion because of the name. A lot of people think that it's giving you a relative strength amongst its peers. It has nothing to do with that. You're looking at the relative strength of the price on a particular chart. So here is what we have. So you're measuring the strength by monitoring the changes in those closing prices. So again, this is still based on the price differences. Momentum is about price differences. It is a leading or coincident indicator. You typically aren't going to see a lot of lag when you look at this indicator. And again, this is why we tend to, most of us have some sort of momentum indicator on our chart. It is bounded, which is something very important with your indicators, at least in my opinion, because I like to, I want to be able to compare this actually across other symbols. So while this doesn't necessarily measure the relative strength of, for example, Ford versus GM, it doesn't really give you that, but you can look at whether it's overbought or oversold because it's bounded. And in this case, you could actually make a comparison of the percentage of one RSI to another RSI, but it's really focused on what's happening with that particular stock. And being bounded is important. Whoops, like I said, because you want to be able to look at overbought versus oversold. And if your indicator is not bounded, you can't really do that. Well, there you go for overbought and oversold analysis. Also, you can use it for divergences. Do you have rising bottoms versus declining bottoms on the price? That usually is an indication of something good, because your indicator has those rising bottoms, but your price at the same time is showing a decline. But you're seeing the momentum despite lowering price bottoms. You're still starting to see some momentum building underneath the surface. This is also does tell you whether the bulls or bears are stronger at closing time. And I say that because when you see the formula, you'll get the feel here of why that's true. So the relative strength index, or the RSI, is equal to 100 minus 100 over 1 plus the RS, relative strength. So this is the relative strength index. This is relative strength through the days. So average of the net up closing prices for a time period. So think about over the last 5 days, since we're using 5 on a lot of these, or actually we'll use 14 since that is the default setting. So over the past 14 days, what were the average of the up closing changes? So we only are looking at days where we had a close to the positive side for that 14 days. And then we look at an average of the net down closing changes for that same period. So think about all those down days, and you're averaging those changes over that time. And the RSI, the index, is calculated by, like I said, taking 1 plus this and dividing it into 100 and then subtracting. So that is how you calculate it. But just so you can visualize, I just wanted you to be able to sort of visualize over 14 days, average of those up closing changes. So let's say the net closing changes are about 2% over time, and maybe the average net down closing changes are 1%. So your relative strength there is going to be 2. 1 plus 2 is 3, divided into 100 minus 100, and that gives you your relative strength index. And here it is on a chart. And again, I used the default up here on the top, but I also decided to throw in some, larger numbers here for the number of days look back here for the RSI. And you can see as you get higher and higher, as with most indicators, they sort of start to smooth out. So again, what you're looking for are possible divergences. Right here, we've got lower lows here, but also lower lows on price. So you're getting a confirmation there. Let's see if we can find a positive divergence. I would say this probably is a positive divergence here at the end of June of last year. You can see the bottoms are sort of trying to rise right here, but look at what's happening with them over that time. They're moving slowly downward. And so that is a positive divergence. And we did end up getting a pretty nice move off of that divergence. Stochastic. Now, this is one, admittedly, I don't use really at all. I've studied it because I've had to study it for my CMT exams. But a lot of people do really like this. I just find it a little too complicated in my head to visualize. But I do want to go over it with you because it is one of the more popular momentum indicators out there. Excuse me. So it tracks the relationship of each closing price to the recent high-low range. So let's say here's your high range, here's your low range. And what it does is if your closing price is here, you're going to check the relationship to that high and the relationship to the low. It consists of 2 lines. The fast line is called the %K, and that's your raw stochastic number. And then there's the slow line, and that's called your %D. And basically, it's just a smoothing of %K. So that's why it's a slow line. Now, remember when we looked at that RSI chart, how each time you added to the smoothing, it smooths out the line. It starts to look, it starts to move a little bit slower. You'll see the more of the undulations from one to the other rather than, a real, a line that's going, you're getting a lot of twitch on it. So you slow it down. And in this case, they call it the %D. The range it is bound is from 0 to 100. So again, I do like to look at oscillators that are bounded because I can look at overbought and oversold. And in the case of the stochastic, there are actual thresholds that analysts use, and it's considered overbought if it's over 80, and it's considered oversold if the stochastic is less than 20. And, when your lines, both of your %K and %D are moving together, that suggests you're going to continue that trend. So if they're both moving together to the upside, that suggests that your price trend moving up is going to continue. So it's useful if you understand what you're looking for when you visualize it and see it on the chart. So how do we calculate %K? Well, %K is the close today minus the line, the low from however many days ago, and then you divide by the high for however many days ago minus the low for during a particular time period, and multiply that by 100. So that is your %K. And L, like I said, it's the lowest point for that selected number of days, and H, the highest point for the selected number of days. So if we're looking at 14 days, then the highest high is what you use for HN, and the lowest low over those 14 days is what you use as your LN. N being the number of days typically 14. Like I said, that is the default. So step 1, we calculated the percent K. Step 2, we calculate the percent D, and that is the 3-day simple moving average of the percent K. So like I said, we're smoothing out percent K, and that's how you would do that. So next to be understood. So the fast stochastic, because you'll notice that you can use a fast stochastic or a slow stochastic or full stochastic on the chart. So a fast stochastic basically uses that original formula for percent K and percent D. It's very sensitive, and it does tend to whipsaw. The slow stochastic adds that extra layer of smoothing. And so percent D becomes the percent K of that regular formula. And then you take the, to make the percent D, the percent K line, it's back and forth. So you've got your percent K line, which up here it was the percent D, and then you smooth it one more time to get that new percent D. And that's 3-day simple moving average of that percent K of the slow stochastic. Unfortunately, they keep the same letters, so it does get a little confusing. But when you use the slower one, you're going to get fewer whipsaws. And that, of course, makes sense because you're getting that extra layer of smoothing. And here is what the stochastics look like. So there's your percent K and your percent D on the full stochastics. And notice when they're traveling together, even this is going upward, it's telling you that this trend should continue. When you start to see that turn, or you start to see one do something different than the other, that's when you start looking for those changes. And as you can see, it says that that trend would continue up through about October, and sure enough, the trend did continue through this movement to the downside. So that's kind of the tricky thing. You know, it is overbought here and it is oversold here if you want to look at it that way. But really what you're looking for is just these lines traveling together or not together. When they have maybe crossovers, that can be an interesting thing to study as well. But like I said, I don't really use stochastics, so I'm not going to get too into the analysis of it because it's just something I don't follow. Moving average, convergence, divergence, and the PPO. These really are totally related. The MACD is the difference simply between two EMAs with a signal line of the 9-day EMA of those differences. It is unbounded. The MACD is unbounded, so you really can't do your overbought, oversold analysis. There's no relative strength analysis that you can do. You can't compare one MACD value to another MACD value. And when you go into the long term, like a long-term daily chart, you can't see the MACD values for earlier in the previous years. It's just not visible. The PPO, however, calculates that percent change in those values. So by doing that, you've now bounded it, and now you can get that overbought, oversold. Now you can compare PPO values to get relative strength. So here is a MACD and the MACD histogram as well. The histogram is basically a measure of the difference right there, so you can see it visually. And you can see when it starts to move down, that means you're getting closer and closer to the signal line. So that's what the histograms measure. I think they are pretty interesting. I'd love to get one on my PMO. But here you go. The PPO, as you can see, really similar. But the difference is that it is bounded. There is a range. All right, the price momentum oscillator, save the best for last. It is a decision point indicator that Carl Swenlin developed. I helped him a little bit with the algebra, but it was really his brainchild. It is a rate of change ratio, and you can use it for historical and relative strength comparisons. So like I was saying, the MACD, you can't really go back in time on a daily chart and see it, but you can do that with the PMO. It is very similar to the PPO, and you're going to see that when I show you the chart. You can use it for divergences. I follow the center line. You can use overbought, oversold. Of course, the crossovers are what gives us our PMO signals that I'm always writing about. All right, so it is, gosh, what did my dad call it? I can't remember that, it was just this really kind of an awkward way of coming up with a momentum signal, but it is different than the MACD. I'm not going to go through this function. I'm not going to go through this, but you have a custom smoothing function. So you have your smoothing multiplier, your function, and basically you're just taking smoothing of price times 100 minus 100. So it's just your smoothing over and over. And the signal line is a 10-period EMA of that PMO line. And here you are with what it looks like. And so I decided to put the PMO, this is our default. That's what I tend to use. I just find it for intermediate term trading to be the best tool for me. But you can also speed it up to use the same MACD calculation or default, and that speeds up the PMO. And I did write about this, I think, in ChartWatchers about 2 weeks ago, if you wanted to read up on speeding up the PMO. I do that for some of my scans more so. Notice you get some crossovers here that you don't get with the other ones. So you can get a little bit whipped around on your signals. Notice also here, never actually got that sell signal, but here we got a sell signal. And yet the price trend continued higher. So this is why I prefer these particular default settings. So here's that chart I wanted to show you how all of these compare together. So on the top, we have the full stochastics with your %K and your %D, PMO, MACD, PPO, there's your RSI of 14 days, and then there's a rate of change for 12, which is the default. So what I find interesting, and what I would imagine that you find interesting, is that tops tend to match up. They just come in at a little bit different times, but they do tend to match up here. And lows, it also tends to match up a little bit more so on, the MACD, PPO, and rate of change, more so than with the stochastics. As you can see, there's a lot of movement back and forth on your full stochastics versus, for example, the PMO with its default settings, which is very, again, it's a little bit slower. You get a crossover back here, but on the MACD, your crossover maybe happen just a little bit sooner, certainly sooner on the PPO. But again, you're speeding up your settings versus the PMO. And again, I like smoothing it out just a little bit because you don't get quite the whipsaw that you get with the PPO and the MACD when you have those faster settings. But if you're a short-term trader, sometimes that makes sense. All right, so this completes what we're doing, momentum indicators. These are the takeaways, just some things you might want to remember. I will have these slides up in the MarketWatchers live recap for today, July 22nd, 2019. So if you wanted to go in, you can get a copy of these slides that way. So remember, momentum is just a speed of the price movement. It's really measuring the accelerator, what you're doing with the accelerator. It's the rate of ascent or descent. That was something I didn't quite cover. When you've got a flat PMO or a flat momentum indicator, that doesn't mean that price is moving sideways. For example, it could be flat if you're rising at the same speed. So you're not pushing down on the accelerator, you're not letting up on the accelerator, you're just maintaining that speed. So what's happening to momentum? It's evening out, it's flattening out. So that's one thing to think about. That's also why we look at some of those divergences. So the slope is what momentum is. Momentum indicators we went over, typically leading, not lagging. measure acceleration or rate of change in momentum. That's what you're looking at as far as what a momentum indicator does. We look at divergences and the direction of those lines, especially with the stochastics. Oscillators, we can use overbought, oversold analysis. We can't do this on the MACD, but all the other ones that I showed you, they oscillate and they have a range. And then there are the defaults on StockCharts.com. So all of the chart that I showed you before with all of them on it, you can just go down and click on indicator, and they're in there, and they are already set with the what usually works the best. So that's all I had, Tom. Man, I finished, boom, right on time too. I'm pretty impressed.
Yeah, and it was a good recap for anyone who maybe has wondered about, momentum indicators and how they're calculated. And I have to say, I don't pay attention to any indicators if I don't understand what they are and how they work, because buying and selling stocks and putting thousands of dollars, of your money to work based on a line pointing up or down, I don't think is a good idea. I think that I personally use these momentum oscillators as secondary indicators. I don't buy or sell based on them, but I do use them to confirm other things that I'm seeing on the charts. But I wouldn't use any indicator at all if I didn't know what it was, or, just the fact that when this line points up, the stock does this based on some other stock I've looked at. I wouldn't just assume that happens across the board.
Oh, absolutely. I always look at crossovers and that sort of thing as we call them with decision point attention flags. I use them for my scans because I should pay attention because I got a crossover, something's happening with momentum. So it brings my attention to a chart, but I do all of my analysis. I include the momentum, but there's a lot more that goes into it with volume and averages and price movement and all of that.
Mm-hmm. No, and I think that's smart. I mean, that's what you want to use. I mean, if you're a momentum trader, which a lot of traders are, I think momentum oscillators certainly are a tool that you can use to find trades. And even like the crossovers you're talking about, a lot of times if a company has its oscillators pointing lower, and especially if it's below the zero line and pointing lower, it's telling you the momentum's heading in the wrong direction. But when you get those crossovers, it could be a signal that things have changed.
Exactly.
All right, it is time to jump into the 10 and 10. So I'm going to go ahead and just start off with our first stock of the day, which is Verizon Communications.
Yeah, and I'll get all these others together.
Sounds good. All right, Verizon Communications, I don't like it. That's a really quick summary. And again, it's just kind of going sideways. It's not horrible. There are a lot of other stocks that are a lot worse. But when you look at the stock relative to its peers, right now it is about an 8-month low. It's just bouncing off a 8 or 9 month relative low versus the S&P 500. So, and it hits relative high back at the beginning of the year, I think, beginning of January 2019. So it's not been a great performer in 2019. I don't expect that it's going to be a great performer down the road, but the charts will tell me. And so for now, I just think it's range bound. I think we're in the middle of a range. Overhead resistance, I think, clearly has been established just above $60. To the downside, you could pick multiple different levels, but I was looking at the double bottom we had in April and May, and then that quick move down at the end of May where we came right back up, and you can see that prior support level held again on a couple of occasions in June. So I think your 54 and a quarter up to maybe 56 area is decent support. And then to the upside, resistance is at 60. Verizon, to me, is just trading back and forth in this range. I think there are better options elsewhere.
All right. And we had two stocks that were most popular in the chat room. And the first one is UTX.
Right. United Technologies. I thought this whole thing was overdone when we had the big drop. And we did hold that prior support area. I think when you look at the relative strength on this stock, it's just kind of going along for the ride. It's not one of your leaders, but I wouldn't say it's one of your laggards either. And double top going across here back in September of 2018, and then again to open May of 2019, right around $142. That's a level that we aspire to get back to on United Technologies. In the meantime, you could probably use the resistance area after the gap up with the announced merger. You can see 135.5 was the gap up, but a lot of selling took place from there. So as we move back up, I think short term, what I'd be looking at is a trading range between about 123 and a little over 135.
All right. The other most popular in the chat room was IWN, which is the Russell 2000 Value ETF.
Well, I'm going to take a look at this on an intraday basis here, because we have been trending lower here over the last couple of days. We did fail to hold the breakout. I'm still concerned about these small caps. I mean, we started to show some relative strength, and now all of a sudden you can see we're failing to hold. That was a breakout level. We could move this down just a little bit. You can see this was gap support from right here. We gapped up to open July, and we're right back down below it. So I would feel really bad if we were to go back down and lose this area down around 117. So I think for now, what I would say is that maybe we're just going to consolidate, and I'm going to say 122.25 down to, and you can see multiple tests here and gap support coming in around this 117 level. So I think this is kind of a range that I would watch for this stock, or for this ETF for now.
All right. Let's see. The next one I'm going to give to you is Dish Network.
All right, Dish. I'll go back to that relative chart. And when you're looking at this is a false breakout today. But I think this overall uptrend looks pretty good. If you take a look at the move here, we've been holding that rising 20-day moving average. And you can see after the breakout, we've come back down. So I think maybe we get another 20-day test here. But this is a stock that on a relative basis to the broadcasters is now at about an 8-month high, relative high. And you can see the group's been strong. So this is the type of stock that gets my interest. And not only, because it's breaking out with volume, but then I look at the pullbacks to see whether or not they hold key areas of support. And when you go back and take a look at where the prior high was, we broke out. Look at these pullbacks, holding price support, holding the 20-day moving average. Volume looks good. Relative strength improving. Yes, false breakout. So I think short term, maybe we pull back another buck or two, but that would be about it, I think. I think Dish looks good. I'd buy it on any selling.
Okay, let's see. Next one up I'm going to give you is Church & Dwight from Consumer Staples, CHD.
All right, CHD. Yeah, I mean, it's in the consumer staples area. I'm not as big a fan of that area as I would be consumer discretionary. I believe market goes higher, and I want to stick with more aggressive names. But this is a stock that has been a pretty good performer. You can see it was right near a 52-week relative high versus its peers to open June, and then pulled back. But it hasn't lost price support. So if it loses price support with that relative strength deteriorating, I'd be more concerned. So I'm going to say right at about this 72 level, we want to watch. And then I think we also may get a hint on how this stock, or after we see how this stock acts at its moving averages, because we see the breakdown below the moving averages. Volume picked up a little bit. Can we get back through those moving averages? If so, I'd be a little bit more bullish. If not, and then we come back down and break below 72, I'd be out of the stock.
All right. Next one is Cincinnati Financial Corp, CINF.
All right. CI.
Property Casual T.
Yeah, this has been an improving area of the market. And this is a nice looking stock. A beautiful move up, very little pullbacks. I mean, this is what I talk about with relative strength. I want to own stocks like this. Back in April, it broke out, and you can see it broke to a relative high versus its peers. Its peers were making a breakout to a new high from the highs established back in September. And look at the relative strength. This wasn't something that just happened here in the last couple of days. This is something now that's been going on for a couple of months. Look at the volume coming in. I think the stock's being accumulated. You can see the recent test of the 20-day moving average was a great time to get in. I would look at two areas. I think the recent breakout along with the recent low. So there is the last breakout right here. We haven't gone back down and tested that level. And then if I show you the recent low right here, I think 99.5 to about 102 is going to be good support on any pullback. If the group sees some profit taking, this stock likely will see some as well. I think if you get it down, 5% from the current level, I think that would be a really good entry point here.
All right, let's see. Next one up is ENSG.
All right, a really good stock within a area that I'm a little concerned about. So if you look down here, you can see that the healthcare providers are starting to roll over again, and we're at about a 6-month low. I think I would watch on the relative chart of the industry group whether or not we hold the last time we had a decent pullback here. So just in the short term, you can see a move up, little sideways consolidation, new move up. Here we pull back, hold a new relative support level there, and move to a new high. I want to hold that because if we don't, and this breaks back over, rolls over, then we know we've got a stock in a area of the market that is really beginning to struggle, and that would mean keeping a tight stop. Now, tight stop might vary by individual, but I would be looking at a couple of areas. If you want to keep one that's really tight, the most recent low, 55. Anything below 55, I'd be out. Probably, I'd be willing to give it a little bit more room. This has been a really strong stock, as you can see, relative to the group. I probably would go down here because after moving to a new high, that was the new low set. We moved back up, and really all we've done is just test this area. So I think that is the more important low, which is just below 53.
Okay, how about Symantec? SYMC.
Yeah, this one I think had been improving. I haven't looked at it in a while, though. No, this one had been improving when it broke above that 23.5 level. I think this was the latest earnings report. And so you can see after the big move down, yes, we've been coming back, but look, software's been coming back. I think this one still is much lower to its 52-week low than its 52-week high. There are so many great software companies that are performing extremely well. I am not a fan here. I think that this is a stock that potentially could falter right here. This is where we had closed before this huge gap down. Now we have just filled this gap, a couple of long tails above it. Not a fan. I think on a pullback, we really need to watch these moving averages right here. If we fail to hold there and roll back over, especially in an environment that has been supporting software stocks, I think that would be very bearish. So I'm going to say no to Symantec. I think there are others much better.
All right. How about Insight Corp, INCY, the biotech?
Okay, I think I pointed this one out recently that it's one of my favorites. You can see it just broke out on a relative basis to a new high. Biotechs love the month of July. We'll see whether or not that holds true this month. Last month, gambling stocks, I said, hated June, and they went up 17%. So seasonality, you can only take it so far. I wouldn't be trading simply based on that. What I instead would be looking for is if we start seeing breakouts in the group, just know that July tends to be a very strong seasonal period. So based on all of that, this has been one of the leaders. So if the group were to break out or if this stock breaks out, I think that would be great entry. I think the last time I talked about it with the failure in that bearish engulfing candle right there at the top, I was looking for maybe a 20-day test. We almost got there, and I almost did it again earlier today. I think that would be the buy point. It would be an aggressive buy because you're getting into an area of the market, biotechs, that are not that strong. But if biotechs do perform well, you've got one of the leaders with INCY. So I could get in at the 20-day with a fairly tight stop, say a close below 82 or 82.5.
All right, let's see. In our very last one, Electronic Arts, EA. Looks like it's getting ready to bust out of a trading zone here.
Okay, yeah, it's got some work to do. On a relative strength, it's picked up some a little bit the last couple of weeks. Still, I think got some work to do before I'd be interested in taking a shot, and I think it would need to get that breakout. So I think right there, that 108 area, I'm not going to get in here knowing that I've got a relative underperformer and I'm getting close to a major resistance area. But if it breaks out and we see this relative strength down here, maybe clear that early June high, and even better yet, clear the high, the relative high we saw back in February, then I think this becomes a better longer term trade.
All right, that does complete the 10 and 10. There you go. There are the symbols that Tom just annotated. I will have these up in the MarketWatchers live blog this evening in the MarketWatchers live chart list. So go to the articles tab, click on the MarketWatchers live blog, and the link for the chart list is going to be right there at the top. All right, we will be back with the final market update after this.
Hi, I'm Julius the Campanar.
And I'm Arthur Hill, and you're watching SCC TV.
All right, it is time for our final market update. Market's not doing too much today, really sticking close to yesterday's close. Currently, the Dow Jones is down, though, a little over 21 points. S&P 100 is down almost 2 points. NASDAQ is also in the negative, down almost 18 points currently. It is down, let's see, it is the one being hurt, well, next to the Russell 2000 the most. NASDAQ is down about 0.25%. NYSE is almost unchanged. S&P 400 moving lower. This is actually a bad chart. It is, we have a couple that are a little bit old right now. Russell 2000, we have, as I said, it's being hurt the most, currently down 0.82%. Treasury yields really taking a dive today. Now we're down below that 2% mark at 1.984% for the 10-year Treasury yield. VIX continues lower. We're now looking at readings below 13.5, but it is currently reading at 13.58. UUP is down slightly on the day, 5 cents to 26.11. Gold, I believe, is on its way up right now, but I can't verify that just yet. USO is down over 3.6% right now, reading at $11.84. Definitely breaking down what we've seen in the past 4 days. We got a recovery here, but now it is dropping by quite a bit. And that's all I have for the final market update. I'm going to pass it back to you, Tom.
Yeah, I just wanted to take a quick look. I mentioned earlier that the Russell 2000 was rolling back over again. And so if we take a look at a little bit longer chart here, I'm going to just go back 6 months. On the daily chart, we did just get that breakout to about a 6-7 week high. And I talked earlier about that intraday IWN and how it was rolling over. And we can see that here. So far, we're not really holding that breakout level. I would feel much better about the Russell 2000 if we hold this level. You can see this was a reaction high back in May. It was also the right side. I mean, if you draw an inverse head and shoulder from this high, this would be the left shoulder. This would be your left side of the neckline. Lower low puts in that inverse head. We come back up slightly higher right side of the neckline. Look at this right shoulder, almost symmetrically opposite this left shoulder, which is perfect. And then we move up, we get the breakout. If we come back down, I'm going to be looking for two things. If we hold this neckline and can rally into the close today, I think that would be very bullish for the Russell 2000. Otherwise, I would be looking for the 20-day moving average, which sometimes will hold or usually will hold if the breakout fails, if that breakout level fails. So I think with the small caps, I would just be watching this 1540 to 1550 area as major support. If we roll back over here, I think that would be a false breakout. And given where the overall market has been, mostly sideways consolidating here, that could be a little bit of a short-term warning sign for small caps. So keep that in mind as we go forward throughout the rest of the day and the rest of the week. Okay, we are going to move now into the market forecast. And I just want to show you a few charts. And I will preface all of this with the fact that I am extremely bullish. And I know some of you are not, and that's okay. That's what makes a market go. You can be bullish, you can be bearish. I'm going to give you a couple of the reasons why I'm extremely bullish. Not just bullish, I'm extremely bullish. I think we're going a lot higher. If you look back at the long-term chart, we go through these periods, and I've talked about this before, secular bear markets, secular bull markets. A secular bear market is simply an extended, long time period where prices go nowhere. We have a little bit of a bull market, then we get another big, serious downtrend. And then we have a little bit of a rally, and then we get another downtrend. You can see in the late 60s, early 70s, this type of behavior. And again, 2000 to 2012, we went through it again. Here was a bear market. We rallied back, bull market. We couldn't break out. Another bear market. This one was even worse, scarier, just like the one back in 73 and 74. For those of you who were trading back then or investing, you know exactly what I'm talking about. That time of our investing history, stock market history, was very difficult. We just exited that. The last time we exited the 70s, we began a secular bull market, and I don't really count the years from the low that was established at the secular bear market. I start the count when we break out of that sideways consolidation. So in 1982 is when we broke out, and you can see we had 18 years. If you go back to all of the troubles we had in the 1930s and into the 40s, when we finally made that breakout in 54, we had about 15 years. Here, 15, over here, 18, 17, 18. Here, we just broke out in 2013. We are 6 years in. Now, I know it's very easy, especially with these secular bear markets recently in mind, to think every time we pull back or every time there's a scare, it's going to be exactly what we saw the last two bear markets. I think you have to change your reference point. I think we're now in a secular bear market or secular bull market. And so the difficulties we saw back in 2015 and 2016, and then also what we saw at the end of 2018, become more of the norm of what you see during downtrends in a secular bull market. They aren't the huge variety that we saw in the secular bear. Now, maybe I'm wrong. Maybe this will all of a sudden do exactly what we saw in the 2000s. It's possible, but we have to make our decisions based on what we believe. I believe we're going higher, and I think that we are nowhere near where we are going to be in the next decade. I think that there are going to be some bear markets, cyclical bear markets along the way that scare all of us to pieces, but I think overall, this is going to be an opportunity. One of those opportunities in a lifetime. I think the market goes a lot higher. So having said that, I want to take a look at a couple of areas of the market that I think we need to watch pretty closely. And the first one is one of my favorite relationships in the market, the XLY versus the XLP. We're just looking at a big long-term chart here and comparing it to the S&P 500. And what I want to focus on are the periods that follow a move down in the XLY XLP. Now, the XLY XLP, and I think I explained this in my blog this morning, so if you want to go back and review that, you can. But anytime we get a move down here, what the market is telling us is that it's favoring the more defensive XLP, the consumer staples companies. When we're seeing a rally, it's favoring the more aggressive consumer discretionary groups. After these pullbacks, these relative pullbacks, you can see during this bull market, we have had big rallies in the XLY versus the XLP. When we have these big rallies, that is when we get the biggest movement to the upside in the S&P 500. In the 2.5 years that this XLY was rallying versus the XLP, the S&P 500 went up 70.5% in those 2.5 years. The next 2 years, when the relationship was just kind of spotty and sideways, we actually went up, but we went up very little. And when we had this big pullback, that's when we had the scare in 2015 and 2016. From that low, we had this huge rally in XLY versus XLP. During that period, the S&P 500 in a little more than 2 years was up almost 50%. 2 years. Look at what happened. We just went through another one of these periods where we had this huge move down, the XLY versus the XLP. And you can see the S&P 500 has really struggled. But since that low in December, we have been moving back up again. And look at the S&P 500's climb. So far, 23%. Now, I don't know if we're going to have a 50% move. I don't know if we're going to have a 70% move. But one thing I do know is that I'm going to follow this ratio on the XLY versus the XLP. Because if money continues to pour in, and especially if we can get another breakout above the high that was established in 2018, that to me would be confirmation that we are going to likely see a big move higher in the S&P 500. So this is something I would watch. Now, down here at the bottom, I have a correlation showing you that the direction of the XLY versus the XLP is very positively tied to the direction of the S&P 500. That's what this chart down here at the bottom tells us. One more chart I want to go through, and that is the transportation average versus the utility average. Now, this one's a little bit more complex because it's not just about the S&P 500. It's also about the 10-year Treasury yield, the direction of interest rates. Because most times when the 10-year Treasury yield is going down, it means money is rotating into Treasuries. And that doesn't mean the S&P can't go higher, but it does mean that there is less money to push the S&P 500 higher because you got a lot of money rotating into Treasuries. Again, $1 into Treasuries means $1 not going into the stock market. So here the S&P went up in 2011, 2012, even though the 10-year Treasury yield was moving lower. But what that yield moving lower did is it created a better environment for utilities. So low interest rates, when the Treasury yield's going down, you have income investors that are looking for alternatives. One of the things they look to are utilities, which pay high dividends. So when you get this move to the downside, not only is it restricting the movement to the S&P 500, but it also tends to take transportation stocks out of favor versus utilities. But look at what happens when transports are moving higher relative to utilities. In this move here, in a little over a year, well, less than 2 years, the S&P 500 went up 55%. In this move here, which was about 2 3/4 years, 57%. This move, a year and a half, 44.5%. I point this out because the length of the relative downtrends has been anywhere from about a year to a year and a half. We are currently a year and a half in here. If this starts to turn back up again, which I believe it's going to, this also would be another factor that would suggest that we're going to see a big move up in the S&P 500. We have seen the 10-year Treasury yield moving down, and while we've been having this difficulty, you can see the sideways action on the S&P 500. The S&P 500 is, have you ever heard the Wall Street saying it's climbing the wall of worry? Well, we've had plenty to worry about the last year, year and a half, and the S&P 500 right now is sitting at an all-time high or pretty close to one. Imagine if all of a sudden 10-year Treasury yield moves up and money begins rotating away from Treasuries and transportation begins to outperform utilities and the XLY breaks out versus the XLP. All of this to me would point to a major move up in the S&P 500. So I'm going to summarize this thing by saying that I believe the S&P 500 going back to the poll within the next 18 months, I believe our high is going to be over 4,000. I'm going with that outlandish view that I'm sure not too many people view and agree with, but I think we are in the midst of what could be a very, very significant rise to the upside.
Wow. And that's till the end of 2020, right?
Yep, that's the end of 2020. I think that the end of December, that low marked the beginning of 2 years of very similar S&P 500 moves that we saw back in 2016 to 2018 and 2011 to early 2014. I think it could be to that magnitude. So even if it goes up 50%, which was the lower of those two, from the low on the S&P 500 at 2,400, that would be at 3,600. So that to me is kind of the low end of my target. The upper end, I mean, I think we could be well into the 4,000s. Let me just say that.
Wow. Well, everybody knows I'm a little bit more bearish than you are. I mean, I still think we're going to see quite the move. I'm still worried when I look at my monthly chart. I'm not getting the the information there to think that we're going to get, huge moves to the upside. I still think there's some correction that, we'll have to experience, obviously, in and around there. But I put between 3,200 and 3,400. A little less on that than you, but yeah, that's kind of what I'm looking at.
Okay. Well, we'll talk about this more right at the end of the show, and we'll bring up the poll and talk about that. But first, with the market doing so well, I think this is a good time maybe to review some chart breakouts.
So, heck yeah. All right, let me show you. First, I used my scan because, like I said, I use that PMO to give me those attention flags. But when I'm looking for a breakout, I want to see some serious volume coming in on the day. That typically is a signal of a breakout. So that's basically what I did my search on. I added the PMO in there as well. But this was what I ended up with. I think I had, well, let's see, how many? 27 charts, I think, in here. So I want to go ahead and just put them in candle glance because that's the best way for me to look at what breakouts might be something to really think about. This one was really interesting to me that I saw AVLR, Avalara. I like that breakout. Look at the fact we've been in this trading range all the way since May. And those tops, that $75 range has really been it. We did close above that yesterday, but today we're seeing some follow-on action. It's up 1.45%. PMO is just about ready to give me that signal to the upside. So I like the look of this. And honestly, you could make a case as well for an ascending triangle. Flat tops, rising bottoms, and the expectation is a breakout with a move about the size of the back end of that triangle. So we're looking at what, 62.50 to 75. So you would add that to the top, and we're looking pretty good here. I like AVLR on chart breakouts. What other ones are looking pretty good? Cerner looks pretty good. It's already been on the move. And it hasn't really had an opportunity to pull back to the breakout point. But we do see that we've got a PMO that's rising. The PMO is almost ready for its PMO buy signal. So I thought Cerner looked pretty good. Let's move on down a little bit more here. Let's see, Kratos. I know we look at this one often. We're getting a nice breakout here. And again, I'm looking at a lot of these ascending triangle formations right here. Got the breakout yesterday, ended up falling back down within below that area of overhead resistance. Today, it's pretty much trading the same way, but we're at the top currently. I'd like to see that hold, but look at the PMO. It's starting to turn over with that breakout, with that ascending triangle. So those were just a few that I saw on my scan list, but I thought I'd give you some time to show me yours. But yeah, other ones, VRSK, nice breakout, and Allegheny looks very interesting with that breakout forming there and the PMO moving up.
All right. I am going to go right in. I'm going to race right into this first one, which is Ferrari, and the ticker symbol is RACE. Beautiful move to the upside. I tell you what, I'm not a big fan of autos. I talked about that earlier because of the long-term track record. But if I was going to buy a stock in this space, look at the relative strength here on RACE versus the group. Not only is it outperforming the autos, but it's wildly outperforming the S&P 500, despite being part of a group that really can't get out of its own way and hasn't been able to for many years. So this is a stock that continues to perform well. It is making another breakout today to the upside, and I think the relative strength certainly supports. Now, if this stock all of a sudden started underperforming the autos and maybe broke below that relative low in June, then I think we'd have a problem. All right, next up, GPN. I own Global Payments, so just disclosure there. I'm a little concerned about today's action if it fails because we had the breakout, but so far we're back down near the low of the day. I've been holding a little bit longer of late. It's killing me, but at the same time, I'm learning a very important relative strength lesson to hang on to these companies because they do tend to go back up. But Global Payments right now did set a new high, so I did want to mention the breakout here. And look at the relative strength. I mean, again, this is beautiful. Every one of these areas moving up from left to right tells you that this is the type of stock. And by the way, all of this movement, you can see very strong volume. So I think we're getting a lot of accumulation in the stock. Next up, FLT. This is Fleet Core Technologies, another one that just broke out yesterday and today. Volume was decent yesterday, but again, look at the relative strength here. Very strong. The group has been okay. So if the group were to make another high, I think that would be even better for Fleet Core. So FLT, I think, looking good on its breakout. HEI, this is Heiko Corp. Look at the volume on this push to the upside. And I know everybody, when you get these kinds of moves, you say, well, I'm going to wait for it to pull back. Well, good luck. I mean, sometimes these companies don't pull back. And when they get that burst of relative strength, sometimes you just have to pull the trigger. I don't like to chase, so I don't own this one. This has been on my list for a while because I was waiting for the pullback. And like I said, it hasn't even had a 20-day test, but it does continue to move higher, breaking out to a new high. I just wanted to mention it so that you'll have it for your watch list. If you like to watch stocks like this, it has been one of the best performers within the aerospace group. And then my last one is Air Products, APD. This is a company that has continued to break to new highs. It's doing it again today. And once again, look at the relative strength versus not only its peers, but the S&P 500. And it's doing that in a group that hasn't been strong. So you can imagine if this group were to break out on a relative basis, this would be one of the leaders you'd want to have in your portfolio. Those are the stocks that I had in chart breakouts for today. There are the symbols that Erin and I just covered. And I think it's time to take a look at that poll and to talk about this a little bit more because we do have a couple more minutes left.
Yes, absolutely.
So what did you say? You said 3,200 to 3,400?
Yes, that was my answer. Was in there, and I mainly just because I think we're going to have a correction in here somewhere, and so it'll have to just make up some of that. We had the correction at the end of 2018. I see something similar, maybe not that far of a pullback, but it's taken until now just to get back up to the highs that we were seeing back then.
Mm-hmm. Well, and for those of you, I know that this is a little confusing because we said what's the high target. We're not talking about your target where you think the market will be at the end of 2020, just simply where you think the high will be over the next 18 months. So if you believe, I mean, we're sitting at 29. I'll give you the
52,
exact. What is it?
29.78.
I'm showing 29.62 right now. On the S&P.
Which one we updated?
Yeah, I mean, I think it's down just a couple points, 29.62. But anyway, if you selected 3,000 to 3,200 as your high, you're essentially saying the market's not going up. It's going to go down the next 18 months. So that is the bearish answer. We're not looking to see where the low target was. That could be maybe a question for another day. Over the next 18 months, where do you think the lowest price would be on the S&P 500? I think the market could pull back. Summertime tends to be slow. I wouldn't be shocked if all of a sudden trade fears came back into the market. I wouldn't be shocked to see the S&P lose 200 points. I think it's possible. But everything that the market has had to put up with this year to be at an all-time high, I think, is making a statement. What's that?
Yeah, I agree with that.
Yeah, and I think if all of a sudden a trade wars and agreement's announced, or maybe even just starting to work closer toward it, or maybe the tariffs are lifted, or whatever, I think the market explodes on that kind of news.
Well, certainly can. We've seen it before. Like I said, I just think the only reason I went as low as I did was I'm still looking at least till the end of 2020. I would look for at least one good size correction. And like I said, here's the chart. We hit that low back at the end of 2018, and it took all the way up until April, May before we started to challenge those all-time highs, and then we've corrected back again, and now we're just back to where we were. So really in the last 6 months, we did make this big move, but when you're looking at the high we had before, and we're only just a little bit above it, and how long ago was that? October? So that's all I'm saying is you're going to get some pullback in there, and I think that could affect what your high target ends up being.
Okay. Well, there's certainly, different answers for sure. Everybody's got different opinions. We shall see, though. After 18 months, we'll know. All right. That is it for today. I do want to thank all of you for being with us. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody, and we will see you back here tomorrow. Happy trading.